Hello, everybody, and welcome to our class. Today, we're going to talk about strangles strategy. We're going to talk long and short strangles. We're going to see what is this strategy is all about. How can we benefit from it? I must say this is one of the most popular, really, this time it's for real, one of the most popular strategies around the world that is commonly used by a lot of portfolio managers and other traders. And we can see how we can build a range here that we can profit from. Either it goes up or stays in place. Pretty similar to the other strategy that we've learned, the straddle strategy, but kind of different. And let's start. So we're going to see that we have basically two different types of strangles. We have a long strangle and a short strangle. Long strangle means that the investor simultaneously buys an out-of-the-money call and out-of-the-money put option. The call option strike price is higher than the underlying asset current market price, while the put has a strike price that is lower than the asset market price. This strategy has a large profit potential since the call option has theoretically unlimited upside if the underlying asset rises in the price, while the put option can profit if the underlying asset falls. The risk on the trade is limited to the premium paid for the two options. Well, in other words, you can see that we have here this strangle. And you can see that basically you're buying out of the money call and out of the money put, and you're hoping for the best. Now, by buying out of the money calls and puts, that means that you're paying less premium. That means less money. That means that your potential loss profit or loss is narrowed. That means that you're paying less, then you can lose less. And this long strangle strategy basically aims to a volatile market that is predicted that's going to be in a market pretty soon. And you're not certain where it's going to go, but it's not going to stay here for long. And you're thinking, yeah, it's going to be volatile. It's going to move away from this current position. And therefore, you're buying out of the money options. Now, as you have learned before, we are also using short strangles, which is exactly the opposite. And that means that the investor doing a short strangle simultaneously sells out of the money puts and out of the money calls. This approach is a neutral strategy with limited profile potential. That means everything you got from the selling of the options, that's it. That's all the money you can make. A short strangle profit when a price of an underlying stock trades in a narrow range between the break-even points and the maximum profit is equivalent to the net premium received for writing the two options, less, of course, the trading costs. Right, so you can see that it looks like this, looks like a table. That means that you have sold out of the money call and out of the money put, and you got this wide range. And as long as the market stays within this range, you're going to make a profit. Now let's sharpen our studies and see an example. All right, so we'll start with the long strangle. And in this example, we're going to see that the underlying stock price is at 100 and call 110 costs $5 and put 90 also costs $5. And they are both out of the money. The multiplier is 1. And let's say there is a month till the expiration. And we're going to build a scenario and a cash flow diagram, as you can see here. And let's assume that, again, we're going to have three kind of good or bad expirations for us. All right, so in this example, when we're going long strangle, that means that we're buying. So we're buying out of the money call and out of the money put. Each one of them costs $5. That means that all in all, we have a fixed cost of $10, okay? You can see here in this diagram. And now let's assume that we had a very volatile month. And let's say the stock has plunged 30% and went down from 100 to 70. So let's see our cash flow and how much we're going to make. So, of course, remember that when we bought a call option, naked call option, just like in this example, that means that the call 110, of course, expired out of the money and it is worthless, and we lost $5 over it. But the put 90 that we bought entered the money and gave us a very nice profit of $20. But do remember that we also paid premium for this option, put option, and it was also $5. So then, even though it paid us 20, all in all, we need to deduce $10 of the cost. And that means that it gave us a net profit of $10 for this strategy. Now, keep in mind that we had a very volatile month and 30% drop down in the underlying asset. That's pretty much, that's serious numbers, and still we only got $10 for it. Okay, now let's give a less better example. Let's say that market went down to 80 and we still had to pay $10 for both options. But this time, the put option paid us only $10. That means that it reduced exactly our call and puts buys and gave us nothing, zero. That means that this is our break-even point. 80 is our break-even point. We're not losing, we're not winning. This is, well, you can say a sad, but it can go even worse, because any expiration between 90 and 110 is going to be worsened. I mean, that's the worst case scenario for us, that the market wasn't volatile enough for us and it expired somewhere between 90 and 110. By the way, it is even worsened because any expiration between 79 and 119, we're still going to lose money. All right. So for the 90 expiration, stock price went down to 90, then that means that the call option, of course, has expired worthless. And also the put option that we bought for put 90 also expired worthless. That means they're both paid us nothing and we still had to pay $10. That means that we lost $10. And also it goes pretty badly also at 100. The same calculation, we lost all our premium, market wasn't volatile, also 110. What happens at 120? Finally, we are entering something which is better. That means that we are on a break-even point here. That means that now the put 90 has expired worthless, but the call 110 gave us $10. That's what it was worth at the expiration. And but we still had to pay previously at the beginning of the month. We had to pay a cost of $10. That means we're on zero. And finally, if it expires at 130, similarly, just like at expiration at 70, we needed a large movement in the market with 30% rise in the underlying asset, and we still got to make only $10. Again, call 110 was our biggest winner here. It was $20 worse at the expiration day, but still we had to pay $5 for him for the initial call 110, $5, and of course put 90, which we sadly also lost $5. All in all, this is the strategy. Long straddle, and soon we're going to start also seeing some real live examples, but also keep in mind that this is how it works usually. I don't know, 80% of the time you're going to lose money if you're not buying the straddle very close to the strike price. You're going to lose money. That means that you need a greater and wider movement in the market to profit something, and it's going to be pretty much the same on every other assets that we're going to see with higher or lower implied volatility. You're going to see that you're going to need a serious movement in the underlying price. Okay, so but what it works, and when you get a really good, fluffy expiration with a lot of happiness, what it's called. So when the market really shook it up or down, then you can make a significant amount of money. Okay, so this is the long strangle. Now let's see the short strangle. And this is a very, again, popular common strategy that a lot of option traders do. And this time I'm talking serious. This is real. This could 80% of the time this strategy works. I mean, of course, it depends on the wideness of your strategy and how far were these options that you sold. But generally speaking, let's go back to the example, and you see the prices are the same, but this time we're selling those options and we're getting a premium of $10, $5 each. And let's see, at stock expiry at 70, we're busted. That means that we only got a $10 premium received, but we had to pay a lot for the put 90 that we've sold for $5 because it expired worthing $20 against us. But we only got $10 all in all from both the call and the put option, and that gives us a net total of loss of $10. All right, so at 80, as you can see, this is our break-even point, because even though we gained from the call option, which has expired worthless, and we got all the $5, put 90 still had a value of $10. Okay, so that's the difference. 80 minus 90 plus $10, the total premium received, we're getting a 0. This is our break-even point here. 0. Now at 90, at 100 and 110, this is our best days. These are our most happiest days, because this is our wide range. This is the range we wanted. We thought the stock is gonna stay here between those two, within those two ranges, 90 and 110, which is not bad. That means that it's almost 10%. It's 10% from each direction, goes up or goes down. And these between 90 and 110, we're getting the maximum profit. And that means that we've sold whatever we've sold, we've earned. That means that if it expires as 100, we got $10 premium. And as you can see, it stays here. We're all good, because put 90 has expired worthless, and call 110 also expired worthless. Good. So, but if we're going to sharpen it even more, you can see that every point between 79 and 119, we're still going to make some profit. Even at 119, we're going to make $1 profit. And then also at $70 expiry at 79, we're going to make, expiry at 81, we're still going to make money. See, so between 81 and 119, that's even in a greater range. It's pretty wide. It goes almost 20% for the upside, and also almost 20% for the downside. And every point here between those two numbers, 80 and 120, we're going to make something. We're going to make a profit for sure. Where we're not going to make profit is, again, the 100 expiration value of the underline. If we're going to get 120, that means that we are break even and 0. And of course, any expiration above 120, like let's say it's 130, we only got $10 premium all in all for those both combination of options, but still call 110 had a value of 20 in expiration, and we only got $5 for it. So all in all, we had to pay 15, and we only got $5 more for the put option that was burned and expired worthless. So all in all, we're losing $10, and it's so on and so on. It goes up. If it goes up, our losses are going to be greater. If it goes down harder, our losses are going to be harder. It goes all the time, one by one. You can't have the whole cake eaten and stayed, you know, without any other. You can't have it all right. All right. So the pros and the cons in these strategies. So, or again, so we're gonna see that in long strangle. All right, your pros are benefiting from the asset price moving either direction, but you got to have a big change in the asset price. That's cone. Cheaper than the other option strategies like straddle, of course, because straddle is buying those calls and puts right on the strike where the market is, and it's always going to cost you greater money. It's going to be much more expensive for you to buy it. But when you're buying a long strangle and you're buying those options out of the money, for sure you're going to pay less. And of course, the best thing from this strategy is also that you have an unlimited profit potential, because if the market skyrockets or crashes, you're going to make even more money. That's a good thing. Now, the cons of it, the last cone, it may carry more risk than other strategies. Then that means that if the market wasn't volatile as you wanted it to be, then you lost and you're busted. That means that you lost. And it is, I guess, pretty big numbers. You're going to lose money if the market doesn't move really significantly. Now, in a short strangle, the pros are that you can have a large range between break-even points. That means that it all depends on you. Where are you going to put those two options for sale? You can put it really, really far away from the strike price in each direction. And statistically, don't catch me exactly on the word and the same word here, but it works. It works. 80% of the time, it works. You're going to make a small profit, but in a very wide range, and it works. But one time, you've done it successfully 9 times, the 10th time, market is volatile. It always happens. And then when it's volatile, it goes against you. It doesn't matter in which direction, you're going to lose money. And you can lose a lot of money. And you've risked some significant amount of securities with those margin requests. And you got a very small premium. And all in all, you lost, and you might lose a lot of money from this strategy. So, you have to calculate your risks. The good thing also here that the time effect and the Vega effect can benefit for the seller, for you. That means that as long as the strategy stays within those two break-even points, the time effect is going to affect for you. You're going to benefit every day, the theta effect from it. Plus, if the implied volatility is going to slow down or go down, then also the pricing, the theoretical pricing of those options that you've sold also going to drop down. And you can make an instant profit just from the volatility reducement. Okay. Now, really, the cones for this strategy is you have a very limited profit potential. I mean, again, when you sold something, you got money, you got the premium, and that's it. You're not gonna make any more money out of it. And you have to pray hard so that the market will stay between those two break-even points. Your loss potential is endless. And I don't need to explain it again. And make sure that whenever the market also moves, you're going to require margin securities to rise. And it doesn't matter where the market's going to go. If it goes up or down, you're going to for sure need more securities to edit, because the broker is going to ask for more securities. All right. So now we've said that, let's move and see an example. And we're going to go on Zoom. Everybody probably knows these days what is Zoom. Zoom currently is being traded around 331, and this is our option chain, and you can see that there are multiple multiple expiry days here, and let's go on the 32 days expiration, a little bit more than a month from now. And as you can see, you have a not bad implied volatility, which is pretty high at 55 plus. Implied volatility both on the calls and the puts, and you can see that if we're gonna buy if we're gonna buy this Strangle here for 32 days, so let's see how it's gonna look. We're gonna analyze, we're gonna buy a Strangle, and it's gonna give us this, excuse me, there we go. So we bought the 330 and the 325, 327 and a half. We bought call and put. All in all, it cost us a $42. Maybe I'll give another example. It's not wide enough. Let's say we're going to buy out of the money put. And let's say we're buying here a single put, 320. It's going to cost us around $13. And we're going to buy the call 340, also out of the money option. And this is how it looks. We paid 13 and 15. Let's say we have those round numbers. So our risk profile is going to look like that. The premium is pretty high. As you can see, it's going to cost us a lot of money. That's exactly $2,800 that we have paid premium to buy Zoom Strangle for 32 days. In other words, we need a serious movement from the stock, and we needed to make it here at least 292. I have to drop down 292. That's well, almost 10% from the current strike price, or has to rise up to around 368, which is also somewhere around 10% movement in the underlying. Otherwise, every other point here between those two, we're going to lose money. And these numbers are for real. That means that this stock has to move within a month, this kind of range. Otherwise, we're going to lose our entire initial down payment for those two options. And it's pretty much that's $2,800. It's a lot of money. But on the other hand, once it moves above, we can make $1,000 if it makes it to 377, 378, and also on the other side. Well, question is, do you like it? Will you take these kind of risks? Do you think that Zoom can move 10% in 1 month? I mean, when you look at the implied volatility of the underlying, and as you can see, it goes around 60% yearly, and that means that monthly it's around 5%. So monthly, the stock can move between 5% to each direction. Generally speaking, don't catch me on a word, but this is what it means, that it can move 60-something% in a year from here to there. So in this case, and if you're thinking that, geez, this stock can, stay here for a long time, and yeah, look at it right now. It reached her peak in those Bollinger Bands, exactly stopped here at 333, as you can see, and also can go down all the way to 280 something. As you can see, if you're doing this kind of trades on technical analysts you can see that it might range between those 2 points, between 330 and 290. So let's have a vice versa strategy. And let's say we're gonna, if we understand this, then we might do something like that. Let's analyze, let's sell this put out of the money for $300. Yeah. And we're gonna say that I don't think, let's go for 350. Okay. Now let's analyze a sell. And we're getting a premium of $10 here, $11, excuse me, and we sold both calls and puts out of the money. Not in equivalent range, but still, we got this. We sold the put here 280, and we sold the call here at 350. Now, as you can see, we got a $1,400 premium, $1,410 premium. But look at the margin request here is $5,300, and our break-even points is going to be here at 364 and at here at 365. That means that we're going to get extra premium for each side that, well, if it goes down, we've got all the premium from the calls, and if it goes up, we've got all the premium from the puts that we sold. And this is how it goes. You can say, let's start. You can say that you don't believe that the stock market is going to stay here for long, and let's see that how the theta effect is going to affect us. And that means that as long as the Zoom stock will remain between those two points, 350 and 280, every day passes by, theoretically, we're going to make $72. And it's going to rise every day that the stock remains between those two ranges, in this range. And you can see that the theta is also rising every day that passes by. We're going to make even more just from the theta effect every day until expiration, until it makes it all the way to 30 days, 32 days of this option trading. So that's it. If it works, it works. And it might give you almost $1,500. That's not bad. Just keep in mind that once it reaches our break-even point at 365, our margin request is going to rise almost double. It's going to be $9,000, and on the other side, if it's going to drop to 280, it's going to be $6,200 just a margin request. Okay, so this is the example that you might believe. Now you can also go even greater. I mean, you can say, why even doing this? I can go for 200, I can sell. I'm gonna get here $20. It's not gonna drop down to 200. I mean, it's way too much. The stock is not gonna be crushed for 33%. And on the other hand, I don't believe it's gonna make it to 500. Okay, you can analyze also and make it even greater. And you're gonna get here $45. Very nice. Very wide, extremely wide. Look, where is our break-even point here? I don't see it. Oh, it's here. It's below. It's at 199. And on the other side, on the upside, it's gonna be here at 501, almost 500 and a half. So now I'm getting, look at this, very wide range, very wide range. All the way between 500 and 200. if the stock remains between those two lines, we're gonna make a profit of $45. It's not much, but it's pretty wide. And I can't say that it's a bad thing, but just keep in mind that anyway, your initial margin request is going to be $3,300, and you're going to get a revenue of $45, and that's also before premium and costs. Don't think if it's a good strategy for you, because I mean, it's not really worth this kind of premium. But on the other hand, this is pretty wide, and you have a pretty good chances that the stock will not reach one of those two break-even points. But keep in mind that it also might happen. And once it happens, you have to close it right away. But most of the time, stocks don't make such a big, tremendous 33-40% movement in 1 month. Unusually, on the average, and nothing happens, and it's a pretty big stock, they tend not to make these kind of big changes in the underlying in just 1 month. But again, everything can happen, and everything already happened. And this is for your calculation, your risk taking. If you're a risk lover or not a risk lover, this could be a good strategy for you. And that's it. This is all I can say. Now, also our last example here, let's give an example in the QQQ. And you can see that the QQQ has a very short implied volatility right now. We're gonna look at the 4-day expiration, and the QQQ is on 333 right now. You can see that the premium here on implied volatility is somewhere around 16-17%. That's so high for a 4-day strategy. And you can buy, it's going to 334, that's going to cost you $5, that means $500. And let's just analyze, if you're going to buy this Strangle, it's going to cost you, all right, let's say $470, and you see, this is how it looks. We bought a 333 put option and 334 call option. Kind of diverse between them, but if you're gonna get a movement from here or here, you're gonna make some money. And this now also keep in mind, it doesn't really matter if the implied volatility is high or low. It just matters how cheap or how cheap you got those options, or those calls and put options you got to buy. And if you buy them for cheaper, of course, then your whole strategy might be even better. But if for $3 or even for $2, of course, your risk has reduced here. All you need is to pray hard and hope that something will happen seriously either way. Okay, so, and last thing, of course, keep in mind that you do not want to reverse this strategy and sell it for such a short time, for such a short premium, for just $2. Never do that. Never, ever do that. For just, you can say, oh, okay, we have only 2 days until expiration. Nothing's going to happen. I'm going to sell this straddle, this short, really tight straddle, and all is going to be good, and I'm going to make money. No, never, ever. Please, I pray for you. Never do that for such a short period of time, and don't wait for expiration, because your losses can be very significant. If you're going to do it for a greater premium. All right, that's it, folks. I hope you enjoyed. I hope you understood it. We're going to talk even greaterly in our next lessons. And I'm going to show you another tips that you can do with this kind of strategy. It's a good strategy. And I hope you all have good tradings and success. And I hope to see you next class. Okay, guys. Thank you. Thanks for being here. See you next time. Bye-bye.